As the Iran war continues to drive the economic chain reaction further and further, and more of its consequences are becoming visible here as well, many investors are asking themselves what will happen to peer-to-peer loans now. Are loan defaults increasing, or can you even make more money from the crisis? Or is it possible that both are happening at the same time? And where can investors benefit the most right now, and where could they lose? Let's take a look at that now, and with that, welcome to Northern Finance. My name is Alex Black.
Hi, my name is Alex from Northern Finance. This video was translated with the help of AI so that we can reach more people in their own language. A native speaker has reviewed the translation. Still, some sentences might sound a little unusual. Thanks for being here and enjoy the video now.
And as always, this video is not investment advice, but simply my personal opinion. And that means I could also be wrong. Let's start at the beginning. It's clear to all of us, the longer the Iran war lasts, the worse its economic effects will be. I've already shown how these manifest in detail in this video here. Thanks again for the great feedback at this point. Feel free to check out this video as well if you haven't already. It's really worth it. So, what will happen to your and my investments in fixed interest P2P loans if we experience a moderate or severe recession due to the energy price shock? Well, first of all, the demand for loans will definitely increase. People will suddenly no longer be able to afford certain things. Maybe because they lose their job during the recession, or maybe simply because inflation rises too sharply and their salary doesn't increase at the same rate. This naturally leads to households going into financial debt. And lenders like Creditstar, Bondora, or LANDE can benefit from these situations. But the crisis won't play out the same way for everyone, definitely not. All of them will very likely have more customers than before, very quickly, who are interested in a loan because they need to bridge a short-term liquidity shortage or something similar, and in this way more money can be earned at first. But a crucial question as to whether we as investors will ultimately have to bear losses or make a fortune here is how long this war lasts and how severe the subsequent recession will be. That's why we'll first take a look at the numbers and facts, and then I'll discuss my opinion and strategy for peer-to-peer lending platforms. Given the magnitude of this war and the ongoing disruption of around 10% of the world's oil supply, as is well illustrated in this article here, it is almost guaranteed that a prolonged war will lead to a recession. In addition, this Bloomberg article shows the real impact that the oil price has on you. According to Bloomberg, if the oil price remains at $110 per barrel for a long time, inflation would already rise significantly. Specifically, at $110 per barrel, that means 1% more inflation in the Eurozone than there already is, yes. So this 1% inflation comes on top of what we already have, and in addition also costs 0.6% of economic growth this year. Currently, as you can see here, we have pretty much already reached this price level for Brent crude oil, which is also the most important type in Europe. This price is set at the New York Mercantile Exchange, the most important commodities exchange in the world, which also dictates our oil price. Because oil, yes, is simply a global commodity. As you can see here, we have already, yes, been above $110 in the last trading session. And if we look at the increase from the low, the price jump now, measured in percentage terms, is even higher than at the start of Russia's war against Ukraine. If the price stays at this level, it doesn't even have to rise further. Yes, the ECB will have to raise interest rates. That is as good as guaranteed in order to prevent inflation from getting out of control. Because we are already at 2% inflation on average over the past 12 months, as you can see here, which already matches the ECB's target. If we have significantly more inflation than 2%, whether due to the oil price or for other reasons, the ECB must take action. That is its legally mandated responsibility for maintaining monetary stability. If the oil price remains at its current level, economic growth in Germany would more than halve to just 0.4%, which, after so many years without growth, would once again be a major disappointment. And if the price of oil were to rise to more than $170 per barrel simply because the war drags on and no solution is found, according to Bloomberg, inflation in the Eurozone would increase by about 2% additionally this year and cost 1.2% in economic growth, yes. This would mean that Germany, if the government's forecast proves correct, would once again be in a recession this year. Yes, yet again. And the EU would also slip into a recession. As you can see here, the European Central Bank is only expecting 0.9% economic growth across the entire EU for 2026, and so in both cases, whether oil prices are high or very high, we would have a recession throughout the EU this year. Of course, there will also be countries that are stronger than others and therefore do not experience a recession, that's clear, and then still manage to grow despite these difficult circumstances. And to better understand who is growing and who isn't, let me show you this map of all of Europe. These are the growth forecasts for the current year, although such forecasts should always be taken with caution. These are not facts, but merely forecasts. And as becomes quite clear, the largest economies, Germany, France, the United Kingdom, and Italy, are all seeing growth just below or just above 1%. Only Spain and Poland as large economies are growing significantly more. If you want to take a closer look, feel free to hit pause now. Let's just assume for now that these forecasts do not come true due to the war and high oil prices, and that Europe slips into a recession. If we take a look at a pan-European lender like Creditstar, which is quite popular among many investors, we can see on page 12 of their latest investor presentation that they have now built up a huge loan portfolio of 438 million euros, which brought them 78 million euros in interest in the first 9 months of 2025. This figure would increase significantly in our scenario, simply due to the higher key interest rates, which are also passed on to customers, just like the number of new customers shown down here. But clearly the nice statistic of loan defaults on page 15 would no longer look so good, but would instead rise sharply. It is important to note that the portfolio quality has obviously been significantly improved in recent years, as loan defaults have halved since 2019. As can be seen on page 4, the profit after taxes in the first 9 months of 2025 is more than 11 million euros, which has simply doubled the profit from the previous year. And if we look at the 2024 annual financial statement, we see that at the bottom of page 23, 38 million euros in retained earnings have already been built up here over the past few years. And I think that with this combination of high profits, substantial reserves, and a portfolio with significantly fewer loan defaults than in the past, Creditstar is overall well positioned. Older investors will remember, however, that during the coronavirus pandemic in 2022, Creditstar had payment problems which were resolved relatively quickly. This took a few months and investors had to wait during this time. And while the risk always remains that something like this could happen again, every investment simply carries risks, I believe that Creditstar is now in a much better position than it was back then. If you also want to secure 7.5% to 10.5% interest here, with the option to withdraw your money every day, then click the link below in the video description. I've also left my full review for you there. Bondora is the next candidate we're going to take a closer look at here, and unfortunately they don't publish as much or as regular data as Creditstar, but let's just go through the data we do know. In April, so in just a few weeks, at some point this April, Bondora should also publish their annual report again, and if you don't want to miss my analysis of the key figures from the annual report, then leave me a like and subscribe. That also supports this video, of course. Thank you at this point. According to the 2024 annual report on page 7, Bondora has built up a loan portfolio of 600 million euros, but with loans that have an average term significantly longer than those of Creditstar. Profitability is also lower, although, as can be seen on page 12, this is due to very high provisions of 14.4 million euros in 2024, since Bondora is still in the process of becoming a bank and therefore simply has to meet stricter standards here and also set aside more money for loan defaults. This is simply for regulatory reasons. When the annual financial statement for 2025 is published soon, profits will certainly rise sharply, since these high one-time provisions for the old loans from all the previous years, 2018 and so on, will no longer have to be made. So it was basically a one-off effect. As can be seen on page 11, Bondora only has 14.8 million euros in retained earnings on the other hand. Even though that's certainly a lot of money, it's less than half of what Creditstar has. On the other hand, Bondora also has the better track record, it must be said, and during COVID only had payment issues for a few weeks instead of several months like Creditstar did. Overall, however, I see both companies as well prepared for a potential recession in Europe. The link with an extra bonus to Bondora and my full review are also linked below in the video description. And finally, let's move on to LANDE before we draw a conclusion here. Here, unfortunately, I am not as optimistic as I am with Creditstar and also Bondora if things get tough. I've repeatedly criticized in the last portfolio updates that the loan default rates in my portfolio for farmers are, well, too high, and that recoveries take a very long time, and this crisis could become really dangerous now because the farmers, the borrowers at LANDE, are suffering in multiple ways. First of all, the price of diesel is very important for farmers. Since the beginning of the war, the price of diesel has risen significantly more than the price of gasoline in Germany, and this is also true across all of Europe. And this is very likely to continue for the duration of the war, because as you can see here, from 3 barrels of crude oil, 2 barrels of gasoline can be produced, but only 1 barrel of diesel. The advantage of having more energy per liter of fuel is now turning into a disadvantage during the crisis. In addition, farmers, and therefore also LANDE, are facing the added problem of high fertilizer prices. These are very closely correlated with the gas market, and as you can see here, the price of gas has recently risen sharply. If we look back, the price is still significantly lower, it must be said, than at the start of the Ukraine war, but nevertheless, the price has almost doubled from December until now. If farmers are unable to pass these higher prices on to their customers, they will have to rely much more on subsidies and support from the EU and their respective countries. And this mix of already high loan defaults combined with sharp price increases in the specific sector for which LANDE provides loans, together with average interest rates of 10 to 11%, is simply too unattractive for me to invest more here. I will continue to reduce my portfolio. More problems could arise here, and that's why caution is advised with smaller peer-to-peer lending platforms, especially in niche markets, particularly if they are potentially so heavily affected by the war, yes. You could say that Ventus Energy, on the other hand, is a crisis winner with their power plants and the high share of renewable energies, which are now operating more profitably due to the general rise in energy and electricity prices. But we will see how this develops. In any case, I will continue to invest and will also be on site at Ventus Energy soon, where I will ask specific questions to get first-hand answers here. If you're interested in that, you'll also find the link with a bonus below in the video description, and now let's draw a conclusion. The two largest lenders, Bondora and Creditstar, I see as well positioned in a recession in Europe if things turn out as bad as feared. Of course, we hope that won't happen, but you do have to consider what would happen if it does. Both companies have built up very good profit reserves as well as provisions for loan defaults, while profits reached record highs last year. Nothing can be guaranteed when investing, and it always depends on the individual case, but I find the risk-return ratio of both to be quite attractive at the moment. A cash flow during a crisis is a nice thing, especially when it comes from financially stable companies. Nevertheless, I will withdraw money from both companies if the stock market really crashes again. For example, if the Americans actually invade Iran now. But at that moment, it has nothing to do with the two companies and their financial strength or weakness, but rather with the fact that I am already so heavily invested, and at that point I simply see a good entry opportunity on the stock market and want to take advantage of it. If we experience a severe recession, there will certainly be some peer-to-peer lending platforms that won't survive it. Therefore, I advise you to review the old and soon-to-be-released annual reports for 2025 for all peer-to-peer lending platforms in which you are invested, so that you are fully informed and can better assess the risks. In case of doubt, it may be worthwhile not to invest as riskily now as in previous years, since stability is more important in times like these than squeezing out a bit more return. At least that's how I see the situation, so I'm not going to panic sell or anything like that. I'm going to keep the majority of my peer-to-peer loan portfolio simply because cash flow is a nice thing, but I will reduce it a bit, this overall peer-to-peer share, since, as I said, the proportion compared to the rest of the portfolio has just become too large recently. I want to keep the P2P loan share at 15 to 20%. Currently, we're at around 23%. Because ETFs and Bitcoin have simply lost a lot of value recently, while peer-to-peer loans haven't. They have continued to generate cash flow. And that's why I will buy more if the opportunity arises, but overall I'm very satisfied with my portfolio. That's my opinion on it. What's yours? Let me know in the comments. Looking forward to the chat, and with that I wish you great returns and see you next time.